Housing is on fire in Vaughan, literally. The Bank of Canada makes a big announcement this week, and our big banks have adopted negative amortization almost across the board. And what does this mean? We're going to have questions from our followers. We're going to do the used Porsche tracker today, and we're going to take all your questions as we do every week. It's episode 126 of the Wise Old Al Show. I'm Vince Gaetano. Thank you all for joining me on this beautiful, sunny Thursday afternoon. So let's get right into it. What is going on in Vaughan? Yesterday we saw a whole housing project go up in flames just before these things were supposed to be completed. I think the last number was 71 homes were either burnt to the ground or damaged in the surrounding neighborhood. And you know, folks, this seems just a little bit too much of a coincidence. I'd be driving around gas stations to see who was buying those gas containers, because I believe that this is very suspicious. And you know, it's not like we haven't seen enough of angry buyers of these new homes where values haven't come in and they're struggling to close. We see it in our office all the time, and I wouldn't be surprised if there's a disgruntled buyer out there that probably torched these things. I hope that's not right, but I wouldn't put it past them. But boy, that was sure a blaze in Vaughan. And I'm not trying to poke fun at it, because I'm sure this has caused a lot of heartbreak for those folks ready to move into brand new homes and those living around it. But boy, what a gong show up in Vaughan. And will this create a trend? Wow, just very, very interesting. The Bank of Canada made their announcement, a big nothing burger. They held steady, not doing anything to the Bank of Canada. Tiff Macklin, Tiff the Static Dragon, held firm and indicated that it seems like inflation is on its way to a more controllable level and on its way down to that target rate of 2%. Although we're still a long ways from it, he does believe we should achieve it by the end of 2024. 2024. It's another year, more than a year and a half from now. So for those folks that are looking for any relief on the variable front, it's probably not going to be a while before we see any reduction in rates. I know some people were calling for rates as early as the middle of this year. It's not happening. At least I don't think so. But I could be wrong. We want to talk a little bit about the hoopla in the market. A lot of folks are excited about what's happening. I'm talking about realtors. Many of them are excited at the activity, the bidding wars. So much happening, so much to be excited about, but there's not a lot of sales. There hasn't been a lot of sales, okay? And let's be honest with each other. In March, we had under 6,900 sales, the lowest sales activity in 10 years. I was out today with a very good friend of mine, a colleague, a friendly competitor. I call him Mark Tamburo. He runs an operation called Get a Better Mortgage in Etobicoke. Great guy. We've known each other for close to 30 years. And, they're struggling. Everybody's struggling. We're seeing a drop in applications, drop in volume. A lot of the deals are tougher. There's no question that what we're seeing every day are tougher deals, people in trouble, people needing a hand, and we're doing our best to give them some tools to get through this next 12 to 24 months, which we believe is going to be a problem. Now, there's a couple questions here. How are we going to get the supply fixed? Well, I want to talk a little bit about something I mentioned in the opening. Our big banks have adopted negative amortizations. And what does that mean? Okay, negative amortization is when you go backwards. Okay, when you are taking longer than you should in paying off your home. Now, I'm going to give you these stats. This came out of a news report that I picked up this week. Okay, as you know, CIBC has $52 billion in mortgages, almost 20% of their portfolio, where mortgage payments are not covering the interest. These are from the static payment vintage. Those mortgages that rates went up, payments stayed the same, and people started going in reverse. They started extending amortizations past the level that they started at. So you got CIBC has noted that 52 billion of their mortgages are ones where people are not even covering the interest. Royal Bank has $75 billion in mortgages where it's just interest-only payments, okay? Like the Never Never plan. They're never paying it off. I think they have a requirement to pay $2. That represents 30% of their portfolio. And then you have TD and BMO, that have indicated 30% of their portfolio have amortizations beyond 30 years, which is the maximum allowable in Canada right now, okay, under OSFI guidelines. So 4 of the big 5 banks, Scotiabank has a true variable, rates go up, payment goes up, and people have to adjust, adapt, deal with it, lock in, do whatever. But 4 of the big 5 banks have a problem. So what has happened? The government's given them tools to extend amortizations, not put any buyers in hardship, okay? And what does this create? It creates a situation where it's almost counterproductive, because if everybody's dealing with this, you're not going to have any homeowners that will lose their homes because they're being given the opportunity of relief, okay? And it won't have a lot of inventory hitting the marketplace that would flood the market and depress values. And by doing so, what the banks are doing is protecting themselves from losses. Because if they did enforce, and you have this flood of transactions hitting the marketplace, the value of homes will drop because there's too much in the marketplace, and banks would get hammered in losses if they did enforce these type of transactions. So it's really interesting, because what is the stress test set up for? The stress test is designed to say that people can afford payments at $525. That was the rate when most of these transactions were done. There was an era and a vintage at $489, but it did bump up to $525. And the question is, if the stress test was put in place to protect people from themselves, why isn't it being put into place right now by having these folks increase their payment to that level of which they were approved to qualify at? They qualified at $525. So it's really interesting. I find it a little bit counterproductive. Not sure why it's being done. And listen, I'm sure the government wants to try to help everybody, but then there's those folks that got into these products that sure as hell didn't deserve to be in them. And where the biggest bulk of the challenges are is in the rental market, where a lot of folks bought these investment properties, took out variable rates, and now they're dealing with significant shortfalls of cash flow because the interest cost being written off against income is showing a negative cash flow. And for those that have traditional variables, they're really upside down, can't increase the rent for the most part. They're kind of stuck, handcuffed, and it's created a bit of a problem. But it's an interesting time. It's very unique. Not sure where it's going, but a couple things that came out that I talked about on the Revealing Real Estate show I do on Tuesdays with Nico Pedisano of Remax OP team. This is a real issue. 2/3 of Canadians reported cutting back on discretionary spending in recent months. 14 points higher than reported around this time last year. So 2/3, that's 67%. 67% can't spend as much as they would like. And a lot of it has to do with the increased mortgage rates. Now, we are seeing more and more people impacted on the discretionary spending front. There is less spending. There are certain places where you're still seeing it being spent like crazy, but for the most part, we are definitely running into a situation where people are starting to cut back. Okay, it is happening. It takes a while to filter through the system, and it's going to be interesting to see how these renewals start being handled. Okay, there is a lot of sticker shock. We're seeing a lot of folks looking for some assistance, and we got some interesting solutions for them to get them through this 12 to 24 month period. If you know anybody that needs a hand and is looking for some assistance and some hand holding, please reach out. We would love to give them a hand. It seems like that's all we're doing these days, but there are some great tools out there to give them some assistance and get them through the next little bit. Not sure if there's any questions that came through yet, but here's a question. Realtor Siva, does any negative amortization stay at renewal? Well, this is what's going to be interesting. At renewal, if you're going to move to another lender, it won't. You have to abide by the contract that's in place if it's going to be a straight transfer. If you got to try to refinance, then you have to requalify at the new rates and whatnot. But for the most part, lenders are being given latitude to not put people in hardship situations. So I'm really eager to see what type of tools and what stretching of amortizations we're going to see. Like if you got people that are just paying interest only and they're going to continue doing that, they're never paying off their home. Like it's like the never plan. So it's going to be interesting to see what will transpire over the next 2 quarters, because 60% of all mortgage renewals will take place in the second and third quarter. Traditionally, our business is very cyclical, and we see 20% of the transactions in the first quarter and the fourth quarter. So 20 in the first and fourth, and then 30% in the middle 2 quarters. So we're going to see a big chunk of that 1.1 million mortgage renewals that are scheduled to come due this year in April, May, June, July, August, September. So we're going to see some interesting situations. We are experiencing some private funds that are not renewing, and it's putting people in some difficult situations. These are folks that aren't regulated by OSFI, so mix private lenders, and unfortunately these folks are going backwards in the rehabilitation cycle. So, you know, if people who watch on a regular basis, I always talk about rehabilitating. Someone who's rehabilitating their credit and their position in lending goes from private funds to alternative funds, and then they move up the ladder to prime A lending where it's cheaper. What we're seeing over the last 12, 18 months is people going backwards because of the stress test impact and not allowing people to borrow as much as they could have in the past. So we're seeing a lot of prime A lending type borrowers move into the alternative space, where you now have higher rates, shorter terms, and lender fees and broker fees. And then you move from alternative into privates. And sadly, we're seeing some of these private clients who are coming up for renewal that can't go anywhere. So they're going into the second and third level of private lending, which have 3 levels of privates. You have the sharks, the scorpions, and the snakes, and you just got to make sure you deal with the tame ones who aren't going to hurt you. And there are some really good private lenders out there that are willing to help you, work with you, but you really got to be it's really important you deal with somebody who has a wide net of private options to go to that can help you out. Power just went out, so that's why things went dark, but we're still live because we're on Wi-Fi. So folks, if you do need help, please reach out. We're willing to help you out. We'll do our best to try to give you a hand, and anybody you know, please refer them. We'd love to help out. Whatever we could do, we will. Let's see if we have some questions here. Big crowd today. Wow. Shouldn't you guys be outside in the sun? GG Mortgages, 2 S's on the end. Extended amortization have been available for quite some time now. Just hearing about it more now due to higher rates. Help me understand how that could be. But cause I am, Vince, better the way than losing your home and having a financial meltdown. Well, listen, I'm not here to hope pain and suffering for folks, but the reality is we're here to help out. We're here to give people some options, but at the same time, when you're in too deep, sometimes it's best to get out of the mess and cut your losses. So what we do is we properly assess everybody, and what I will do is not give you the kittens and rainbows and make you think that things are going to get better. I'm going to tell you the way it is. I'm going to be honest. I'm going to try to help you protect your equity and stay away from folks who are just going to try to access as much of it as they can to profit from it. So if you do need help, please reach out. We'll help you out. I think there's another question here. Sat on rates too long and then raised too fast and too much. Yeah, well, that's what inflation will do. Thanks for the compliment. Rajan 929. If there is a potential for rate wars with the bank spring summer, would it be good time for those in variable to consider locking in for a little relief? Well, you know what? That's a really good question, but I always want to caution people. If you started your variable within the last year or two, you're not going to have the full breadth of options when it comes to terms, because a lot of the conditions of these variable products require you to have a 5-year commitment with them. So if you took a 5-year variable last year and you're a year into it, your only option to lock in would be a 4 and a 5-year. You wouldn't have the option to lock into a 1, 2, or 3 because they want a full 5-year commitment. So the amount of time elapsed off your term is what is the minimum term you could access, and they usually want it to be to the full year. So if we had a client who called us up, she had 2 years, 2 months left on their terms, hoping to get a 2-year term. They said, sorry, the least amount of time is 2 years, 5 days before they would allow her to opt for a 2-year term. So they always want the 5-year commitment. And if you want to lock in, I'm suggesting to people, consider the 3-year. The 3 year is a really strong term, gets you through this mess. You might have to chew a little bit on the last year, but at least it's not 5 years where you could then maybe take advantage of some softening, hopefully, that can occur when the Bank of Canada is ready to maybe take the foot off the gas and start tampering down this bank rate. But thank you very much for the question. So let's talk about rates a little bit since we're on that topic. So the bond market, the Bank of Canada held steady this week, as you know, but what did the bond market do? A lot of people are saying, oh, rates are coming down. Well, this is what the bond market did. Last week, we were sitting at 2.891 on the bond market. And this week, it went up over 20 basis points to 3.109, so almost 311. So it's almost a 12 basis point increase. And what is very interesting to note is when you have the significant portion of your portfolio, which we talked about with these big banks, sitting in negative amortization or interest-only mortgages, they're technically not performing well, which means that OSFI and the regulators require more capital requirement for these non-performing or concerned loans. I'm not going to say default because they're technically not in default. They're just not paying the interest as per their setup contract, right? So when you have banks that have to put more capital aside, they have to make up the spread somewhere else. So they're not necessarily passing on discounts to new borrowers that are entering the market. We're not seeing the rate wars we usually see at this time of year. Usually they're killing each other to try to get market share. And with the bond market going up 20 basis points in the last week, it doesn't bode well for a potential rate war. So we'll see what that looks like in the next little while, but we're going to keep an eye on it. And we're middle of April. Usually we have these rate wars starting end of March, even right after March break, and we just haven't seen it yet. So really interesting to see what's going to happen here. Use Porsche Tracker. As everybody knows, I use this data point to kind of give you an understanding of, are people trying to get rid of toys? And we started tracking this in September of last year, where the number of used Porsches for sale was 944 at the time. And that was used Porsches for sale within a 100-kilometer radius of where I sit at Dufferin and Orphis, just south of Yorkdale, where my office is. And it went as high as 1136, 1138, I believe. It's now come down to 1044. So Last week we're sitting at 1,066. This week we're down 22 Porsches. So maybe they started seeing the good weather and started buying these things because they want to rip around. They saw a lot of convertibles in the last couple of days taking advantage of this great weather. So maybe there is a buying spree out there of these used Porsches because there are less of them for sale. And that represents only a 10.6% increase over where we started at 944 in September of last year. So we'll keep an eye on that. We'll see if we see more or less Porsches for sale. Okay, Mark, who I was with today, thought that was funny. He drives one and he goes, that data point is just a killer. But try to have some fun. You know what? That's what we're here to do. Realtor Siva, do you think prices will drop in Toronto? You know, this is a really good question, and one I get asked a dozen times a day. I don't know. The only thing I know that's going to happen in the next year is I'm going to be a year older, just like all of you will be a year older. But for the most part, I think the City of Toronto core is going to do well. I think single-family semis, townhomes are going to do very well in the City of Toronto. I'm really concerned about the condo market. Could be flooded. We'll see where that lands. But I think the City of Toronto will do well. I think it should do well, and I'll leave it at that. Will we see blood in the streets if people start to lose their jobs? Well, people are starting to lose their jobs. We're starting to see it. We're starting to see some folks. We had a client in here, worked for Amazon, lost his job, not happy. We're trying to help him through getting a little bridge facility to get him through till his next job. These are things that we're seeing on a regular basis, and things I think we're really good at. I think what we try to do is we try to turn negatives into positives and have them think through the process as opposed to living in the moment, which is not always a fun situation, but we try to project out a period of time so they could see better days and a better future, and they have a goal to strive for. But I think we're probably going to see more and more job losses as the discretionary spending starts impacting businesses and commercial numbers and stats. But there's no question we are heading into a recession, and it's going to be a tough go of it. So, let's hope it doesn't get too bad, but be aware that it's coming. I'm going to get into some questions. As you know, we're going to use the questions out of the helmet. As you know, my favorite saying is, tighten up the helmet, chin strap. It's going to be bumpy, so let's get right into these questions. From Ambrose Lou. Would you recommend to buy a house now when first-time home buyer? Well, where will prices go? Well, I think if you are a pre-qualified first-time buyer, I encourage you to be patient and try not to get caught up in a bidding war. I know it's difficult to do because you got a lot of pent-up passion to get into a home. You get emotionally attached to properties and you want to fight for it and you want to bid the most. But I think it's very important that you be patient, deal with a realtor that's going to help you with the right property and give you control of the transaction, where you could probably put a condition of financing so you don't have any buyer's remorse. And I think rates will probably settle depending on where you want to be. I still think the 905, these communities outside of the 905, where these bedroom communities, as you would call it, I think they're going to continue to struggle with valuations as more and more people have to go back to work. We're definitely seeing the city starting to hold a little bit in valuation, especially the city core and the West End. And there might be deals. There's probably going to start being some deals as we start seeing some of these renewals come up and people starting to see some sticker shock where there isn't as much latitude to put them in interest only or negative amortization mortgages. So I'll leave it at that, and hopefully that answers your question. Let's get another one here. Personal guarantee for a corporate mortgage, which lender doesn't report the person on credit bureau? This is from Realtor Siva. I think he asked the question earlier. This guy asks a lot of questions. Holy smokes, I think I'm nicknamed Columbo. All corporate mortgages do require personal guarantee. There are some lenders that don't report, and they're primarily in the alt and private space. Okay, a lot of the alt and private space lenders are non-reporting lenders. That means that they don't report to the credit bureau. But all the prime A lending operations will report you. So it all depends. If you're in the private space and you're in the alternative space, they may not report, but it depends on what lender you're in. Not sure if there's any other questions being asked here. Realtor, you're giving great information. I'm sure a lot of people don't like your information, like lowest March sale in 10 years. Well, it's the truth, right? Like, let's talk a little bit about that, okay? So, with all due respect to all the realtors that are watching, I'm not here to piss on your cornflakes. I'm not here to burst your bubble. You have a job to do. You got to get people excited. You got to motivate them to buy, blah, 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 blah. But here's the situation, okay? There were only 6,896 sales in March compared to almost 11,000 last year. And everybody says, well, Vince, there's not enough listings. There's not enough listings. I said, well, okay, let's look at the active listings. In March of 2023, there were 10,120 listings, active listings. And in March of 2022, there were 10,157 listings, active listings. It's only a difference of 37. So there are the same listings. What everybody needs to realize is people cannot qualify for as much as they need to borrow to buy in this market. The stress test is preventing them from going out and buying with reckless abandon. That's the problem. We're seeing people who buy with conditions, okay? They get their mortgage, they don't qualify for A, we recommend an alternative option. They don't like the rate, they don't like the payment, and they say, you know what, I think I'm gonna bail out. So when these sales prices, these sales numbers are adjusted with the people that pull out, is it really 68.96 in sales? I don't know. I don't run the board. But I think we gotta be honest with ourselves, okay? The rates are high, and the values of homes are still relatively high, and they're being artificially maintained because banks are extending amortizations, banks are not enforcing non-payment of interest on billions and billions of mortgages, dollars in mortgages, right? Like CIBC, 52 billion aren't even covering the interest. Royal Bank has 75 billion that's paying interest only. You got TD and BMO, 30% of their mortgage portfolio has amortizations over 30 years. They're going backwards, right? So that's not helping the market. That's not helping the listings. You have people that are artificially feeling good because they're not having to make the payment. And there's a professor, I think the professor from Ryerson or whatever they're called now, Metropolitan University, he indicated someone would rather go on negative amortization than have to pay an extra $600 in mortgage payments, okay? They want to stay in their home. So banks are accommodating what the government and the consumer advocacy agency is suggesting. Work with the borrower. If they're making their payments as agreed, let them go, let them be. So it's good, something's gonna break. Like either the banking system's gonna start to bleed out because they're not getting the interest that's due to them, and they're gonna start charging more on new stuff, which is really low as far as volume is concerned, or something's gonna break. So there's gonna come a point where at renewal time, people are gonna have to pay the piper. And hopefully these values hold. But it's very clear the banks have made a concerted effort to all behave the same way to prevent a flood of power sales to get into the market or force people into this sales environment that would depress the value of homes, which causes losses for them. Because if there's a value drop in the marketplace, because of the behavior of all the banks doing the same thing, it would cause significant losses for them. So I think it's clever, but let's make no mistake, there's a reason why they're doing it. They want to prevent any losses on their books. And it's an interesting way, but people should understand why it's happening, okay? They're basically protecting their bottom line. Why do you think the condo market will be flooded? Sorry, missed first 10 minutes. This is from Sham 99998. Okay, there's 32,000 condos that were to be delivered into the marketplace in 2023 that were going to be registered. 19,000 the first 6 months of the year. And what we're finding is a lot of these folks are having difficulty getting the financing that they thought they were going to get when they first bought these places 4 or 5 years ago, when rates were a lot less. Because a lot of these condos were for investment purposes, there's negative cash flow, right? The rent isn't covering the interest costs plus condo fees plus taxes, and it's preventing some of these folks to get the original financing that they thought they had, and it's pushing them down the lender credit ladder and into higher price loans. And many of them don't have the sustainability to maintain those negative cash flows, so they want to get rid of them. They want to sell them. They tried to do it in the assignment market. That market was pretty shitty or non-existent. So you're going to see a flood of these condos, these new condos from people that don't want to carry negative cash flow. So it'll be interesting to see what opportunities lie out there, but let's make something very clear. About 70% of these units are one bedrooms. Okay, they're one bedroom shoe boxes. And as immigrants pour into this country with families, it's tough to raise a family in 500 square feet, okay? Like, the only thing you could do is put bunk beds and hammocks in these things to accommodate a family, okay? So I don't know if that's the proper type of housing that's needed for these folks that are coming here. So that's another issue that we could cover another time, but let's hope we could get through this. Mr. Valensky, I thought we were ready. Well, kind of. No one wants to declare it, but we are. Okay, what a crowd. 65, 67 people. This is unbelievable. So Mr. Valensky recently celebrated something. I think he had a kid, or so congratulations. I saw that post. I never met the guy, but he seems like the happiest-go-lucky guy I've ever met. Like, this guy always has a smile on his face, and you should have seen how proud this guy was holding up his child. It was just really cool. But hats off, congratulations, give him a thumbs up. Mr. Valensky, in Vaughan, we had 37 new listings yesterday. Before that, we would have 12 listings or so. The listings are finally going on the market. See, this guy's on the ball. This guy knocks on thousands of doors a day. Hats off to him. Never met him. Still invited him for an espresso. Hasn't shown up. Waiting for him. Hulk Hogan. He just said listings aren't the issue. No one can afford the housing without extending amortizations. People are basically renting from banks for life at this point. Correct. Very, very good point. Folks, we are at 35 minutes after the hour. We still got a bunch of questions. Okay, let me see if I can get a few more. Brienne XW. Hi, Vince. How will it affect the rental market for condos? I think if there's a flood of them and people want to hang on to them, there's going to be more choice for renters. I don't know if it'll impact rates significantly, but for the most part, if there's a lot more in a building than normal, you're going to have some price competition amongst landlords trying to get the place rented before the others. Only the well-capitalized landlords will hold off getting the rent they want. So there might be some deals in there depending on the type of landlord you have. Some people just want the cash flow. They don't want to have any empty units because they got to put in the full cash to cover mortgage, property taxes, and condo fees and insurance. So they'd rather take something than nothing. I have a client of mine. He's got like 14, 15 of these condos. He'll just this is at the beginning of COVID. He just took whatever he can. He was getting some rents of $1,600. Now he's well below market. Some of these places are going for $1,000 more, but he has great tenants. Didn't have very high mortgages, and he's okay with it. But he's well below market. And as he says, he goes, I'll never lose these tenants. Why would they leave? They're paying practically nothing. But you know what? He's not greedy. He's happy. He paid his places like 280, 300 grand, and they closed at the beginning of COVID. And he just wanted people in. Because remember, at the beginning of COVID, people were moving out of the city. These units were going empty. People were moving in with their parents. They had no income. So they had to leave. So it was a different market. And now we're seeing it the total opposite of it. So it's really interesting to see how that panned out. Perigene Properties. Pandemic drove up prices in cottage country. Do you think prices will settle back down on recreational properties? Absolutely. I think if you're not on the water and you paid a premium for your condo, you're going to take a bath if you got to get rid of it. And those folks that took variables that are now seeing the payment to carry these secondary homes go up, they probably want to get rid of these headaches because they're just cash cows. And remember, you can only use them in parts of the year, not all of them, and that becomes a problem because you're not utilizing them and they're not making you happy in the wintertime. So they're going to sit on your mind and they're going to bug you. They're like a bad itch. Okay, they're going to just sit there and say, this is a money grab, a money pit, let me get rid of it. So we're already seeing that in cottage countries. We're seeing more and more come up. My wife tracks this stuff. She's always looking for a cottage to potentially buy, and she's seeing more and more listings as the weeks go by. But it'll be interesting to see how that works out. Thanks for the question. Well, listen, we are at 4:37. I want to thank everybody, and I just want to point something out, something I've been saying every week. Be kind to each other. You know, there's a lot of people out there struggling, and some of them won't talk about it. Some of them will just keep it inside, and it could be a coworker, it could be a friend, it could be a family member, it could even be a sibling, and they're not very open to talk about financial problems. Not many people do. And I think it's incumbent on those that have the wherewithal to help to do more of it. Share it. If you could buy somebody a lunch, a dinner, buy them a drink, take them out, take off some pressure. I think you'll be doing some good work. You'll be doing some wonderful work, and it may make the difference in somebody's day, week, or month. So be kind. I want to thank everybody for tuning in on this beautiful Thursday afternoon. I don't know why you're watching me, but thank you from the bottom of my heart. And if you know anybody that needs a hand, a friend, a family member that's looking for a second opinion, looking for an option, a solution, please pass along my name. Please reach out. We'd be happy to help. We got a great team here that's committed to holding people's hands and showing a bit of empathy. So good night. Enjoy the weekend. Go Jays, go. Great start to the homestand, and we'll see you next week. Take care.